Mr. Steve Swartzman. He's a principal in C3 Capital in Kansas City, Missouri. Mr. Swartzman is testifying today on behalf of the National Association of Small Business Investment Companies, the professional association for companies that administer the SBA's SBIC program. Welcome to the committee.
Chairman Schrader, Ranking Member Buchanan, and members of the subcommittee, thank you for giving me a chance to testify on behalf of the National Association of Small Business Investment Committees. My name is Steve Swartzman, and my partners and I at C3 Capital manage two funds that hold SBIC licenses. SBICs are private equity firms that raise private capital and agree to invest exclusively in American small businesses in return for being able to access SBA leverage to multiply the amount of capital available to small businesses. SBICs invest, putting our own money at risk first in small businesses that we think will succeed. First, let me say that this is a great program that has worked very well for us and our investors and the 33 companies in which we have invested over $137 million over the past 6 years, all the way from Florida to Oregon. Our companies have created thousands of jobs and greatly added to the economy in countless ways, all at no effective cost to the taxpayers. The program works and has great and dedicated people in place. So I come here not to criticize, but to promote the growth and utilization of the program. This is a market-based program, not any kind of a handout. The SBA is paid back in full with interest and fees. This is a market. There's also a market need for SBICs, which invest in small businesses that larger funds overlook. We invest in a highly inefficient part of the capital markets that is made more efficient by this program, particularly in a recessionary environment like the current one. We provide loans to small businesses that are beyond the risk profile of banks, and as you can imagine in the current environment, that risk profile has changed pretty dramatically. The SBIC debenture program is authorized to provide $3 billion a year in leverage. Less than $1 billion was utilized last year. All the money left on the table by the end of the utilization of the program is money that is not going to grow our best job creators, which are small businesses. Over the next 4 years, assuming full utilization, as much as $10 billion could be made available to small businesses under the current program, again at no net cost to taxpayers. The SBI debenture program has paid for itself through interest payment and fees and has done so for the past 50 years. So how do we reform the program? First, successful SBICs should be welcome to stay in the program by creating a clear and predictable relicensing system. Our second license took over a year, despite the fact that our first fund had already gone through a lengthy licensing process, and we had the same management team in place and the same strategy, and had a successful fund. If a fund has already been fully vetted, licensed by the SBA in the past, proven itself financially, complied with federal regulations, and passed annual examinations by SBA regulators, also has an adequate infrastructure in place and wants to continue to invest in small businesses, then we believe it should be able to receive a new SBIC license quickly. The family of funds limit, not the individual fund limit, should be raised to allow for successful repeat funds to grow and stay in the program. Successful SBICs are being driven out of the program because the repeat licensing process is so onerous, unpredictable, and expensive. It makes no sense to graduate funds out of the program that have proven themselves to be successful in the small business base. These are exactly the kinds of funds that should be kept in the program. And given that the program is operating at below 30% capacity, there's clearly no danger in using up the program's budget by keeping successful funds in the program. There are a few other additional reforms that we'd like to propose. The energy-saving debenture, which was passed by Congress in 2007, is still not available. The SBA needs to implement this investing tool, and Congress needs to fix the technical error in the statute that excludes most SBICs from the energy debenture program. Currently, even if the regs were in place for the program, only 11 licensees, which have been in place since October of 2008, are eligible to utilize the program. Small businesses, not just large multinationals, should have the ability to compete in the green economy. Further, SBICs should not be disadvantaged as they compete in the market. We need rules more rules to reflect the market realities and protect taxpayers' investments. I also want to mention the financial regulatory reform and how that may affect SBICs. SBICs are already highly regulated and should not be regulated twice by adding an additional layer of SEC regulation on top of that that's already in place. This would add additional infrastructure and cost compliance expenses, and we're already highly regulated by the SBA. In conclusion, just want to say that a fully utilized SBA program can provide billions in capital to domestic small businesses that will create more jobs than any other part of the economy. The Recovery Act was projected to save or create 4 million jobs at a cost of nearly $197,000 a job, but it costs only between $11,000 and $33,000 to create a job via small business investment. If the existing SBIC program were fully utilized, it could create hundreds of thousands of jobs over the next 4 years and do so at zero net cost to the taxpayers.